about where yields were in 2020 and 2021, issuers should have borrowed all they could for as long as they could, right, to fund a lot of these projects, the infrastructure needs that are so prevalent in the U.S. today. And it's a bit of a head scratcher why they're not. When you look at things like debt service, there's aversion to taking on debt. Federal aid has been utilized, I think, in some cases to help, to help balance sheets of states and municipalities. But issuance, we continue to talk to issuers and we say, why aren't you issuing more? And part of it is they have two lists. One is a would like to do list, which means the big, grand, capital-intensive projects, and the other is the need to do list, the maintenance type of projects. And that's really what they're borrowing for. Debt service is way down. So from that standpoint, balance sheets and credit quality is good, but they should be borrowing more. And my premise is that when you think about what the muni market does, whether it be schools or hospitals or bridges or airports or water and sewer, it's all public purpose. Mm-hmm. And there should be a lot more borrowing. And I think what has to happen is there needs to be more incentive created, probably legislatively, to get, for instance, insurance companies, pension funds, to buy them. The low yields, because of the tax-exempt benefit, sure, they appeal to traditional high net worth investors, but there needs to be a reason to attract those other buyers, and therefore there increase supply, which the market needs. The market needs desperately more supply, I think, to create more liquidity, to create more value. But so far, you started your question by saying, what about this year? We don't see a big uptick this year. We're just not seeing that unless something changes dramatically. Taxable, tax-exempt, taxable, as you know, has been going down over the last few years, particularly since we talked in 2022. Mm-hmm. And there's a lot of reasons for that. It's kind of the relationship of munis to treasuries and the arbitrage and so forth. But nonetheless, I think that we don't necessarily see that ticking up either. So issuance is probably going to remain muted again this year, and that's not necessarily healthy for the market longer term.
Mm-hmm. So when you look at muni yields, though, right, they're higher, more compelling than they have been, and from the previous decade. Are they compelling enough? Is this a window of opportunity for investors to get in before the rate hikes and brings yields down more?
So I think it's another good question. The reason because it's a good question is because I think when you take the typical investor and you say, here's a muni bond and it's yielding this, they say, that doesn't look that attractive. And because the notion is that rates went up a lot, right? Particularly in 2022 into 2023, rates went up, the Fed was aggressive, and you look at what people can get in either cash or the front end of the curve. Like a lot of people sitting in T-bills, et cetera, right. And they say, I can get a 5+% T-bill, but my muni bond is only yielding 2% in 10 years. And so I think, to answer your question, yes, yields have gone up. There's more income for every dollar invested. But I don't think there's necessarily enough yield to really open buyers' eyes. And it gets back to your question around mutual fund flows. Is that creation of value? What's the reason for investors to come back into the market? One of the reasons, is going to be significantly higher yields. Mm-hmm. How do we get there? Maybe increased issuance would be one reason. Maybe we have another big credit dislocation, disruption. Those tend to be, we're not predicting that by any means, but that's one reason we could see a dislocation. They tend to be temporary and short-lived, but we do need to create more value. There is this, I think, misconception that yields have gone up a lot. I can go out in 10 or 15 years and get a significantly higher yield. It's not necessarily the case. The other aspect is all that money that's going into the SMA space is going into the intermediate category. The intermediate category in municipals is the largest category, whether it's in SMAs or whether it's in intermediate mutual funds. That's where all the assets are. So that part of the curve is particularly rich. And I think oftentimes people say, where can I buy a 10-year muni? And they see the yield and they say, it's really not that attractive. I'm going to stay in cash. Mm-hmm. Now, our argument to that is you have to reduce your reinvestment risk, because ultimately, as we've seen with some of the volatility with the market anticipating Fed cuts, the market will cut and force rates lower in the front end far before the Fed actually begins cutting. Mm-hmm. So in order to reduce that reinvestment risk, when you're sort of left, rates go down and you have to reinvest that T-bill or that one-year piece of paper, whatever it is you're buying, that in order to reduce that reinvestment risk, you take some money and you move it out to we've kind of like the 15-year part of the curve. You can get 90 to 95% of the income of the entire curve by going out 15 years, taking less duration risk than you would in 30 years. Now, I'm not saying all of it, but a component of it we think about moving out. So that's to reduce reinvestment risk. But your question around yields is a really, really good one, that there is that misconception that I think we still need some dislocation to really attract long-term sustainable flows.